Good afternoon, ladies and gentlemen, and welcome to the Solid State PLC results presentation. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout the presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab on the right-hand corner of your screen. The company may not be able to answer every question it receives today. However, it will review all questions submitted and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that today's presentation is being recorded. I would now like to hand you over to Gary Marsh, Chief Executive, Peter James, Chief Financial Officer, and Matthew Richards, Managing Director of the Systems Division. Gary.
Thanks, Tom. Welcome everybody to our 2025 annual results. I hope you find the presentation informative, and we're very much looking forward to taking your questions at the end of the slide deck. So without further ado, we'll press on. So just talk you through the agenda of what we're going to be talking to you about today. So I'll briefly talk you through what we'll be covering in the presentation. We'll be looking at the key drivers during the period and what the outcome of the strategic defence review means for Solly. Then we'll move to financials. We'll then talk you through the four key pillars of our strategy and M&A. That'll be familiar to some of you who followed the story for some time, but for others maybe not so. This will be followed by reviews of the two divisions of the group, which are components and systems, closing with the outlook and the strong prospects for the group before taking your questions. So the quote at the top of the slide really does encapsulate what we do. Very easy for you to say, Gary, but what does that actually mean in reality? And it really boils down to two things: know-how and capabilities. The know-how of our people to work hand in hand with our customers, become an extension of their engineering team, designing in the right technology for the given application. We spent decades investing in our test and measurement and production capabilities, and year by year we continue to develop our infrastructure. And today there are very few, if any, independent businesses, certainly in the UK, that have the breadth of infrastructure that we now offer our clients. Collectively, our know-how and our capabilities help us to create real stickiness between us and our clients. Many of them have dealt with us for many, many years. And as a group, we work hard seeking out new customers for the future through our marketing initiatives. We now have a 50-strong BD and sales team, and we exhibit at numerous trade shows around the world. Moving to the organisation, the business is currently split into two divisions: systems and components. We'll provide a divisional review later in the presentation, but suffice to say, the two divisions are highly complementary. From FY26, so the year we're now in, we'll be reporting as three divisions: systems, power, and components. The mission of Solid State over the medium term is to build an agile business of ever-increasing scale and resilience for the shared benefit of all our stakeholders, and our primary measure of scale being earnings per share. So what I thought we'd do is we'd start with a slide on the key drivers in the period we're reporting on. FY24 was a particularly strong year, with revenue pulled forward from FY25, which is further compounded by the delay of a $25 million contract from FY25 into 26, the year we're now in, as you can see from the graph. We had reports back from shareholders that they want to see more granularity on the sales mix, and these project revenues, as we term them, are now highlighted in pink and white on this slide. This shows the underlying business has been very resilient despite the post-COVID electronic shortage, destocking and industrial headwinds, which have impacted most significantly our components division and US power business. Positively, the delayed program has now been reconfirmed, and the commitment to that technology gives us real confidence that there'll be ongoing multi-year demand, albeit these large investments, as we've seen previously, are not guaranteed each and every year. The middle top chart highlights the electronics market headwinds, which we're all in the sector are familiar with and we've all faced for the last 18 to 24 months. However, positively, the data indicates we're now reaching the bottom of that book-to-bill cycle you can see in the middle there, and we're now trending more positively. It's important to point out that the normalized lead times are returning, so sort of 12 to 16-week lead times that we're seeing, and customers' order schedules are shortening, which does present a headwind to the absolute value of open order book. However, we're very pleased to report that our absolute open order book from that non-project business has continued to build steadily, as you can see. The final chart highlights shareholder feedback where they want to see quality of earnings, excluding the project earnings, improve and grow. This is absolutely part of our strategy, and what we'll be doing is we'll be recycling some of the profitability from the project revenues to underpin investment in our higher value add capabilities, such as the Ashchurch site, the facility you can see the bottom right there, and investments developing our US communications capabilities following the acquisition of QPAR USA last October. I'll now hand you over to Matthew, who will talk you through some of the key findings and key outputs of the Strategic Defence Review.
Yes, thanks, Gary. So yeah, the SDR, it's a review that links defence investment with industrial revival. That's certainly the aim. There's a focus on enhancing the UK's advanced manufacturing sector with the intent in reducing the reliance on overseas suppliers, and that would provide a long-term national resilience with sovereign capabilities. Solid State is continuing to invest in engineering and manufacturing capabilities, which will certainly position the group for mid to long-term growth, and those are really supported by these SDR commitments. Some key themes looking to the cues from the slides: the Navy modernisation, the hybrid Navy as it's been termed. That'll encompass naval drones, undersea vessels, operational edge computing. These are all parts of the NATO first doctrine for interoperability. We've had a bit of fun to say these are all well within our solid state wheelhouse. That pun was intended. We'll see an expanding undersea and surface fleets, including the new nuclear submarines, 12 SSN submarines, more frigates, autonomous vessels, and some keen-eyed might have seen this week, Royal Navy received some new autonomous mine hunting systems. They've come into service and they incorporate some communications technology from our company. Beyond the maritime environment, there's a planned investment is also seen relevance across the group and across all of our divisions. Again, AI, cyber, drones, and communications. Bit of a mouthful, but the creation of the Cyber and Electromagnetic Activities Command has direct relevance to our antenna business. This unit is providing jamming and defensive spectrum monitoring, so directly increased demand for ELINT COMINT capable systems. So these are capabilities within our Leominster antenna facility. Moving to the right, more of the Green Army and aeronautical systems. The Army are adopting a 20-40-40 model, so 20% crewed platforms, 40% in reusable drones and UAVs, and 40% in consumables. These are loitering systems, not directly in our area, but again, more relevance for smart computing, communication systems, providing situational awareness, edge processing and connectivity, and I'll come to a little bit of detail in future slides. Thank you.
Thanks, Matthew. So on to the financial review, and I'll try and bring to life the review for FY25 and some of the prospects for FY26 and beyond. So yeah, starting with the order book, the open order book has made good progress, continued to progress on an underlying basis, as Gary showed on that slide 4. And that's against a backdrop of really strong billings in Q1, which is really very positive. Moving down to revenue of 125 million, marginally ahead of the consensus, upgraded consensus, which is very positive with a strong end to the year. And if we look at that normalized for the communications program and an FX headwind, the underlying revenues are down about 2.5%. The parts of the business that have faced those headwinds are the US power business and the component business. And one thing that's really positive is the open order book for our US power business is up 40% year on year, albeit from a modest base. In terms of gross margins, those gross margins have been very stable at just over 31%. However, operating margins have faced the operational gearing headwinds, and we've continued to invest in overheads to drive midterm growth. And we'll hear a little bit more about that on some of the later slides, the investment in Ashchurch that Gary talked about, but also the investment in our facility in Leominster. Moving down the P&L, so PBT and adjusted EPS of 6.2p. Again, ahead of recently upgraded consensus, 7% ahead, which is positive. And normalizing for those communications programs we saw in the prior year, the reduction in adjusted PBT is a lot less significant. Investments, 1.5 million in this period, 3 million on a full year basis. Absolutely going to start to contribute. The factory is up and running, and you saw that on the picture from the beginning of April, but it will contribute this year and it will have a more meaningful contribution in the year beyond. So FY25 overall is a profitable year. We're confident in meeting FY26 consensus expectations and delivering on our midterm goals. Moving down to dividend, the dividend has been aligned proportionately with earnings, but we have reaffirmed in the announcement that we will restore a progressive dividend as the earnings improve. Coming down to some of the sort of balance sheet and cash metrics, strong cash generation in a year where profit has been a challenge. Focus on cash has been very important to us. Yeah, cash generation in excess of £10 million. And if we look at the net debt number, that has increased, and that's been driven by the M&A we've done in the year and the CapEx spend. Again, we'll talk about some of those on a couple of the later bridges. So an image speaks 1,000 words. You can see there the impact of the communications order and the FX headwind. And then we look at the sort of core business underlying that. You can see the components headwinds, and within systems, there was some good solid growth in the UK core systems business that mitigated the headwinds in US power. If we look at what that translates to in terms of profitability, on the system side, you can see the volume impact of largely driven by the comms business, but also the margin is slightly softer this period with a slightly weaker mix, but also the investment in the Ashchurch facility means our utilization is lower this year. We have far greater capacity now. We brought that second facility on, and there's a bit more detail on that Matthew will talk to. If we look at our components, you can see the volume headwind there. However, pleasingly, the margin has recovered back to more traditional norms of mid-20s. Last year was depressed with the closure of that energy-intensive production line in the US, but this year we've recovered back to more traditional norms. In terms of overheads, there's overhead savings of circa £3 million, and that reflects pulling the belt in, a small number of redundancies and reductions in performance-related pay with the slightly less strong performance. We've actually used that and invested in the business in areas that are going to drive midterm growth and improve quality of earnings. So the investments we've made are absolutely critical for our midterm success. Net debt, coming onto the balance sheet, you can see there the first bar shows the strong cash generation. How have we spent that money? Well, financing the business is interest and lease payments. We've got a dividend at the other end, and we've got the two bars that are absolutely critical in the middle are the investing activities. That investing activities is CapEx on Ashchurch and R&D within our power and antennas business of 3.3 million, and M&A payments for Q-Part and Gateway, which we'll talk to on some of the later slides. The initial cash payments were 2.1 million, and we've recognised 300,000, the small bar there, of deferred consideration. So last slide from me is a net asset bridge, which shows the net assets are broadly stable year on year, slightly down with the dividend payment exceeding the retained profits this year. I'll hand back to Gary, who will take you through a review of the strategy.
Thanks, Pete. Each side of the business complements the other. So components gets advanced warning of changes in the supply chain that are fed through to the system business. Shortages really being a classic example of that. While systems gets advanced access to new designs, while they're still at the architecture stage, allowing components to visit engineers and get their products designed in ahead of the competition. The two divisions are often working together. The most common area being battery power, for example, where the component business development team working with the customer also has a battery pack requirement. This gives each side of the business much greater reach and access to solutions that would not otherwise be available. We've got a long-standing blue chip customer base, which we're very proud of, supplying our trusted technology into their demanding applications. This slide shows a cross-section of our defence and security at the top, medical, energy and industrial and robotics client base. Many of them operate globally, so a large part of our business is fueled by international demand. Renishaw is an example of a component customer that came to us because of our value-added services. They're both now a component and systems client, with Ultramaritime, Philips Healthcare and Ocado utilising our battery packs in their products and services. The benefits of scale are starting to pay dividends, supplying more products to our tier one customers, so improving our organic growth prospects. We're seeing significant potential for further growth here across all of our business units as we broaden our complementary product and technology profile. Clearly, our strategy is a living document, but it centres around 4 key pillars, which were first established in 2018. There's a lot of detail on this slide, which you could take a look at your leisure. But I'm going to focus in on a few areas of drawing out some key elements. So on investing in talent, we've appointed a new and experienced Chief Sales Officer to lead our sales channel strategy in the United States. We're broadening our range of capabilities. Our new integrated systems site in Gloucestershire is now fully operational and contributing to the group, with the recent publication of the Strategic Defence Review calling for investment in the UK industrial defence base. This investment decision, which was taken just over 18 months ago now, has proven now to be very timely. On internationalisation, we acquired Q-Part antennas in the USA last October to better address the world's largest market for electronic warfare, signal intelligence and cyber security. And in components, we further expanded our high margin own brand range with the acquisition of Gateway. We'll provide more detail on this acquisition in a subsequent slide. And finally, we're continuing to develop our own brand component manufacturing supply chain outside of China. M&A continues to be an integral part of our growth strategy. We've always had a policy of a twin track approach of organic growth and acquisitive growth. We recently completed, actually on the 1st of July, an asset purchase agreement with Bresner UK, a valued customer operating in the same field as our System Solutions Group in our components division. Bresner will be fully integrated into Solster. Revenues are small, but access to that customer base with Solster's wider product range and capability offers us the opportunity for growth and improved margin. Our approach is really based on a capital allocation decision between organic investment and M&A, and the best route will deliver on the strategy whilst minimizing risk. In identifying potential targets, we don't have a sort of one-size-fits-all approach. It's tailored to ensure that we de-risk the deal and strategic execution through strong alignment to the 4 pillars of our strategy and our target markets. The financial assessment of the target drives the price we pay, targeting deals that are preferably earnings enhancing in the first year, whilst looking to maximize the ROI by delivering post acquisition growth. The board continues to actively explore attractive acquisition opportunities across its target markets, both here in the UK and overseas. The acquisition pipeline for both divisions is healthy, with particular focus on adding complementary technology in medtech and communications and further internationalising the group. Right, I'll hand you over to Matthew now, who'll talk through some of the component side.
Yes, thanks, Gary. I can put some colour then onto our separate business units division. So starting then here with Solster. Solster are problem solvers. They take that resilient business model that we showed in the earlier slide, and the business then starts with the customer's unmet need, the business challenge. We work with the suppliers and the equipment manufacturers, understand the technology demands and the applications, and turn those ideas into plans into solutions, products and services. Solster provide component, module and box level solutions to complex customer problems, frequently bringing together multiple resources from around the industry. And that could be as simple as finding the right contract manufacturer for a customer, or in more complex situations, it may be bringing together several of our suppliers with a design consultancy to meet a specific customer need. Looking into some of our brands, the electronics component landscape is continuously changing, and Solster remain at the forefront, bringing new technologies to both existing and new customers alike. So we are blending products from long-standing franchise suppliers, the likes here of Digi, Excelitas and others, but also keeping on the leading edge from new partners. And that we have a new one, exciting one, Deepex, who are delivering end-to-end hardware, software stacks that power the likes of intelligent cameras, generative AI at the edge, really incredible technology that significantly reduces power, heat and cost compared to conventional graphics processing unit based solutions. In terms of brands, we add our own brand components, including the Pater and Duracool brands, providing relays, optic-based solutions, and the like. Gary mentioned it earlier, Gateway, the acquisition, our new colleagues. We immediately noticed and appreciate that they have a similar work ethic, a shared work ethic and culture to our Solster team. And there is a benefit that there is minimal crossover on a customer base, something in the order of 14%. It's early days, but there's great opportunity for cross-selling to that customer base. The added value capabilities from the ferrite machine shop are being prioritized as they do deliver improved margins and revenue alike. The team at Gateway add knowledge to our group. In fact, as an example, quite an early win was our antenna team were able to consult with their Gateway colleagues on an EMC issue, and the Gateway folks provided some ferrite components to let us address some EMC, electromagnetic spikes that we had. So we're always learning and gaining from that kind of increased capability in the group. Moving on then to the Steertight systems division, starting with antennas. Again, I touched on it on the SDR slide. For some while, we've been seeing growing demand for more complex antenna solutions. That includes spinning arrays with azimuth and elevation capability and all of the related control electronics. These are dealing with complex electromagnetic intelligence gathering systems for covering radio, voice and radar, and other non-communications intelligence. And we really are establishing ourselves in rural Herefordshire, in Leominster, as a sovereign capable provider, and certainly European based, to address the concerns over dependency on traditional US defence contractors. So we really are forging a name for ourselves in that sector. We're blending the production of less complex antennas, the simple antennas, the reflectors on the left of this image, with much larger complex arrays that build different technologies, different materials and electronic skills. We've been drawing on the skills, again, the theme here of taking capability within the group. We've used this competence of our active silicon team to address some electronic issues for the antenna control systems. Over to the right, you'll see that the antenna going into our anechoic chamber. That's a 3-meter door. We can see the scale of the people standing in the doorway there. That is providing a near field test capability to allow us to test antennas in a clean electromagnetic environment. And we're excited. We're going to be adding capability, a new chamber and vector voltmeters and network analyzers into that team later this year. That will allow more throughput and allow testing at higher frequencies. And Gary touched on it earlier, our US strategy. We're now developing the capability to produce antennas in the US and test them there ultimately, and to leverage our acquisition of the QPAR USA brand and the group sales initiative, which Gary touched on. We move on to the custom power business. While the power revenue, Pete touched on it, actually is broadly comparable with the year on year, just under £30 million. The power business has had a game of or tale of two halves. The UK has seen revenue growth and improved performance, but we have to state that the US business has faced some headwinds, destocking, exiting low margin business. That was very much a deliberate position that we have taken, less attractive, low margin, and just broadly an industrial slowdown. We've taken action over the last year to change the fortunes, and it's had a very positive impact. We've implemented significant leadership changes with the global power business now under a single leader, and he's really continuing to progress this as we look to build strength and depth within the team. I touched on it. We've exited some businesses which have been commoditized and really focusing on our growth markets where our engineering expertise is really valued. This is group wide, but medical, not least, defence, and extending into transport. We've got some exciting pipeline opportunities for non-military drones, which particularly excites me, and portable transport traffic management systems. Furthermore, we're beginning to see customers that are recognizing the value of our international capability, that broad global brand custom power. And we've got a number of customers interested in exploring opportunities to leverage that international presence. The business is very much in a strong position in both the UK and the US. And Peter's already touched on it, albeit that a relatively low base, but we're seeing a 40% uplift in order book and the general level of confidence growing. But the reality is, as a result of the current year performance being below plan, we did take a one-off write-down on the US intangibles goodwill at $3.5 million. I think Pete will be able to convert that into pounds for you. Moving on then into the Ashchurch facility where I sit today, brand new. I touched on it in the earlier slide and Gary referred to it. We've established this facility to address a growing demand for larger scale integrated systems, physically large computing consoles, cabinets and racks. We've got a purpose-built production facility meeting those standards for defence customers, but these will equally map to the likes of transport customers. We've deliberately chosen the facility here in Tewkesbury. It's got access to talent, customers, suppliers, and complementary companies on our doorstep, which really allows us to fish in a different pond. Looking at some products themselves, we've decades of experience of building integrated systems and computer solutions for prime contractors in the UK and overseas. In fact, it was back in 2012 when we relocated to our Redditch facility as a result of a customer saying, can you extend your facility and grow? And we've filled that, and now we're going to replicate that success with our Ashchurch facility. Capacity is a good thing. It's what our customers expect us to do. We're looking to transition from a sub-assembly provider to a fully fledged tier 2 supplier, providing complex subsystems and major assemblies to those tier 1 customers. That is an evolution for us. So as well as the fabric of the building, we've been investing and continuing to recruit talent in supply chain management, program management, and through life cost. And it's that through life support, and the clue's in the name, so that's covering design, equipment maintainability, upgrade, acquisition, training, documentation, ultimately obsolescence management and disposal. So really, we've been referring to an iceberg model. What you see above the surface is the equipment supply, but where there's significant opportunity is below the surface, where you can generate added value and longer term, multi-year revenue, almost an annuity type revenue opportunity. So I think I'll hand back now to Gary to sum up on prospects and the outlook.
Thanks, Matthew. So looking forward, we've got 3 strategic priorities. Firstly, enhancing the quality of earnings by focusing on driving growth in our highest margin business units across the group, which I think we've covered for you in the presentation. Second, we've invested significantly in the infrastructure and talent across the business, with the largest investments being in Ashchurch for integrated systems and Leominster for antennas. We'll continue to build on our technical sales and engineering capabilities, as this is critical to give us that capacity, which Matthew just spoken about, to secure long-term organic growth in the underlying business. And thirdly, whilst we cannot alter the fact that Taiwan is a critical source of supply in electronics, where feasible, we're de-risking the business, securing second sources. So a great deal of work has been done with a number of high quality supply partners in India, which is now progressing well towards providing some viable alternative suppliers for some of our own brand products. So focusing on organic growth, the SDR provides strong government commitment, which can only help in the short to mid-term, certainly through our strategy horizon to 2030. Our investment in our capabilities and facility in Ashchurch is well timed and aligned to the SDR's drive to enhance the industrial base to meet the defence needs of the country. This gives us confidence that we're able to secure more high quality business with defence primes such as Thales, BAE, Babcock, etc., which will underpin future growth of the group. Following the acquisition of QPAR, we're looking to use this as a catalyst to secure growth in the US market, the world's biggest market in antennas. We're planning to invest in USA production, which is aligned to the current administration's commitment to Made in the USA. We see this as a market which can drive organic growth and enhance our quality of earnings. And finally, we've secured medical accreditations, manufacturing accreditations for our Weymouth facility, which has helped secure new business opportunities, and we'll look to roll that out, roll this accreditation out to other sites, Redditch being a good example now with extra capacity, where appropriate, in other areas to provide similar opportunities for premium business. And lastly, and absolutely by no means least, as we've demonstrated, we'll continue to pursue the right bolt-on complementary acquisitions. That concludes the presentation. So very happy now to take any questions you may have.
Super. Thank you, Gary. Thank you, Peter. Thank you, Matthew. Now, if we could turn to the questions. We've had a number of questions submitted ahead of the presentation, but please do continue to submit your questions via the Q&A tab. If we could possibly start with the first one. Gary, what proportion of revenue is defence related?
Peter, you've got the numbers handy. I'll have you talk to that once you've...
Yeah. So if we look last year, defence was close to 45%. This year, defence is about 30% of our revenues. Industrial's about 35%. Medical's up to 12%. Transport just shy of 10%. And then other is sort of 10 to 15. So yeah, it's an important sector, but it's by no means the majority.
I think it's important to say, especially those sort of new to solid state. We spoke quite a lot on this presentation about the defence and security market because it's very much in the news, and it's clearly a very strong market for us. We've been in that market for over 50 years as a group, and with more money available through increases in GDP spend, it will be a key market for us right through our strategy horizon. It's important to remember the diversity of the group. Easy to say diversity, much harder to actually to do it. And I think those of you new to the company, to go back now to our FY 2021 during that COVID period, which is very challenging for most companies, that diversity we had really shone through in the performance we had then. And I'd suggest you go back into the archives and look at that performance. It really does demonstrate certainly the resilience of the group, and we seek to maintain that, especially in areas like medical, where there are a lot of similarities with defence. Requirement for accreditations, know-how, and those specialist products. Real moats you can create round your business to protect it, and those high barriers to entry. So that's something we'll look to develop to counterweight defence over the coming years.
Super, thank you. Two questions on the power business. The first of which is, what can be learnt from the Custom Power acquisition that will help ensure future acquisitions are impairment free? I guess there's a bit of power in there and there's a bit of M&A.
So from my perspective, I think the first thing I would say is I'm still very supportive of having that capability and that business in the USA. I think there have been a significant geopolitical challenges over the period since we've acquired them that would be very hard to predict with hindsight's a wonderful thing. But absolutely, we're now well placed going forwards. I think, we bought that business when the market was very strong. We've had destocking and the industrial slowdown, but that strength of order book now recovering under Dave's leadership. I'm really quite excited about the prospects for that business going forward.
I'd also point out that the market continues to be very buoyant. We've seen a number of our peer group in the US being sold to main New York listed businesses at a greater, if you're looking at a price relative to sales and that premium, well in excess of what we paid for Custom Power. It really does demonstrate the future prospects of that market. And certainly, if you take areas like drone technology that we have now, we just did not have that capability in the group prior to the acquisition of Custom Power, and we're able now, through quite a frankly laborious export control environment we had to go through, which longer than we'd otherwise like, but we've now got that knowledge in the group that we would not have had to translate that into the offering we're going to make to our European drone customers. And as you've seen from what Matthew said in the SDR, that's going to be really very important for the spend in the defence sector. But drone technologies, certainly lots of fantastic opportunities in other areas that are not defence, as Matthew spoke to.
Great. And a follow on from that, from Lawrence, what margins could the power division achieve in the medium term in normalised market conditions?
So I go first with that one. So the margins in power they're quite broad range depending on the nature and level of engineering sophistication. We've moved away from some business that's become commoditized, which would be lower margins, low 20s and what have you. We focus on business that typically is in the sort of mid 30s up to sometimes north of 50. And that's where our engineering expertise at a gross margin level is valued by our customers. And as we, consistent with the whole group, as we utilize our facilities and capability and capacity, that can deliver strong operating margins. Last year we were double-digit operating margins, and we absolutely see that as a realistic goal to get back to.
Matthew,
I don't know whether you've got any further points you want to add with custom power.
Well, no, I'd certainly back to the first question, culture. I mean, people do business with people. I think there's never any substitute for more face time. In what we would do next time, it would just be more just getting to know people. We're excited about that Gateway acquisition because and in the US, as Winston Churchill said, it's two countries divided by a common language, and I think language and communication was something we could work on. But I absolutely agree with what Pete said in terms of opportunity. That's a technicality. The impairment, for me, I'm full of excitement. The business was preemptive in acquiring that US business before the current US administration. We are well positioned now on onshoring domestic capability, but the US by America was always there more than ever now. So we are really extremely well positioned, but with good leadership, good people. We're always looking for talent. It's one of our 4 pillars. So. I'm absolutely full of optimism, and just would echo what Gary said about we are defence today, yes, but some of these opportunities in the non-defence drone market are just incredible scale and opportunity. So just to inject a bit of positivity, I've invested a lot of my time. Some of you maybe on this call will know I've been spend a lot of time over there. We are on good footing and good foundations going forward.
And that's, as you saw in the presentation, is now coming through in the open order book with that 40% increase since last March.
Yeah, great. All right, that's super, very comprehensive. Thank you very much. Further question: how will you make best use of the new capacity at the Ashchurch facility?
One for you, Matthew, I think.
Well, yes. It's having capacity is necessary. It's back to what I said about Redditch, a decade ago, more than a decade ago, when our customers come and see that we're packed to the gunnels and sweating it. That may suit some financial folk, but it wasn't satisfactory for our customers. So creating that capacity, they're visiting here. This is a showpiece facility, a flagship in a way so it's not just the fabric of the building. No, it's not just the test equipment. It's the people. It's adding all of those skills, those through life costs. And we are bidding on exciting new projects, and not all necessarily deep engineering, demanding huge level of engineering support, building the likes of cabinets and racks, air traffic control systems. It's something we've been involved in the past. So we're getting out there and telling the community that we've got the skill, capacity, competence, experience, accreditation to take it on. If you build it, they will come. I am absolutely confident that we will fill this factory as we did in Leominster, as we did in Redditch. Come back and you will see that probably over a 18-month, 2-year period to get to ramming speed.
And as our experience shows, you simply cannot sell capacity you haven't got.
Yeah.
It's not something you put on a PowerPoint slide. People need to come in, see the business. They'll need to, you need the accreditations. They'll need, they'll need to do that, that accreditation themselves and do that assessment themselves. So to have that capability timed as it is, so on the defence side now, I think is very good. And as I said in the presentation earlier, we embarked on that over 18 months ago. So I think bringing that on stream to commence in April, the start of this new financial year, has been very timely.
Super, thank you. One for you, Pete. What are the impacts of the weakening dollar?
We are naturally hedged largely. So the dollar, the weakening currency gives us a headwind at a revenue level that the dollar's moved pretty significantly. However, actually at a profit level, that's largely mitigated because we buy the large majority of our materials in dollars, and we try and match those purchases with dollar sales. And that is a strategy that Gary and John McMichael implemented a long time ago when the dollar went from, was it 2 to 1 point something?
2.40. That'll age me. I think it's at $2.40.
I can't take any credit.
We lost $1, I think, at that point, but there we go.
Yeah, I can't take any credit for that strategy because that was something Gary implemented a long time ago, but it's something we've worked hard to maintain now. But it does mean at a revenue level, we absolutely do see a revenue headwind, as you saw in the chart this year. And we're likely to continue to see with the dollar where it is today.
Great, super. Question from Scott: is the ambition to maintain total shareholder return growth of circa 20% going forward dead?
Well, why don't I take that to start with? And I think for me, the really important thing that we control is earnings per share and growing the profitability of the business. And we're going to work very hard to do that through filling the factories, as Matthew's just talked about. And by filling those factories, growing the top line, the operational gearing of our business, as we've seen last year, when we get the incremental revenue, translates into very strong operating margins. We absolutely believe we can recover operating margins back towards the 10% and a little bit beyond that we achieved last year. And we also want to see the underlying business deliver results like we saw last year. Last year benefited from a project revenue. We'd like to see that level of trading without project revenues, and the project revenues become cream on top of the cake. So absolutely, we believe we can achieve that over the next sort of strategy horizon to 2030. And if we do that, the TSR performance, in terms of share price, will look after itself.
Yeah, our focus is on the areas we can control. I think if we deliver on those, the output will be, that improvement in TSR.
Super. Focusing on M&A, Lawrence asks, is there a favoured geography for future M&A?
The focus currently is around UK, Europe, and the USA. Not so much the Asia Pac region. That's where our focus is at present. We've got a good pipeline, mix of sizes of business, but in geographical terms, UK, Europe, USA.
Great, super. And final question, which is quite suitable actually. What have been the reasons for the good start to the current year?
I think we started to see industrials coming back a bit. It's not where we want it to be. You'll see in the slide I did at the top of the slide deck, we're not yet back to parity of 1-to-1 as a book-to-bill ratio. but it's trending in the right direction. But industrial IoT is strong. We've got great prospects in AI. It's really much as we had when we saw the build out of the internet in sort of the late 90s, early 2000s. That a whole plethora of new products came on stream at that point to deliver that, and we believe we'll see that again with AI, starting with Deepex, which Matthew mentioned in one of his slides. So there's new areas like AI, but defence is strong. Medical has been strong. So I think collectively, with the business units we have, that's all coming together to give us a good strong start to the year, which certainly we hope and plan to continue. And the prospects and the pipeline are good.
I think the only thing I would add to that, Gary, is as you saw on the order book, the $25 million of kitting up of communications products that will, some of which has been delivered in the first quarter, and the remainder will be delivered through the second quarter, means that's a very helpful contributor in our first half as well.
Great. Super. Thank you, gentlemen. Thank you, Gary, Peter, Matthew. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on Solid State, please do get in touch via solidstate@walbrookpr.com. Thank you again for attending today's presentation, and we look forward to updating you soon.
Yeah, thanks for attending. Thank you.
Thanks.